Good question. So having a non-direct recognition policy is not a requirement if you want infinite banking to work. When you look at non-direct and direct recognition, there's really not much of a difference, and there are huge misconceptions out there about direct recognition. Non-direct recognition is definitely easier to understand. So I'll explain both. With a non-direct recognition company, what that means is that the insurance company does not recognize the fact that you take out loans with respect to how they apply dividends to your policy. So for example, if you have $100,000 in cash value, you have a 6% dividend interest rate, and you borrow $50,000 from that policy, what'll happen is you've got that $50,000 loan outstanding, you're going to pay loan interest on that, but the insurance company will pay you the same 6% dividend on the full $100,000 of cash value as if you never borrowed it in the first place, meaning the 6% dividend is applied to the $50,000 that's non-borrowed and also to the $50,000 that is borrowed against that policy. That's with non-direct recognition. You get the same 6% dividend because they do not recognize the fact that you have taken a loan. Now, with direct recognition, how it works is that they directly recognize the fact that you take out a loan with respect to how they apply dividends to your policy. So if you take that exact same scenario, 100 grand in cash value, earning a 6% dividend interest rate, and you borrow $50,000 against your policy, you'll pay interest on the 50 grand. You will still get dividends on the full $100,000 with the direct recognition policy. I want to make that point very clear. Here's the difference. The 50 grand that you have not borrowed against the policy, you'll get a 6% dividend on. Because it's not borrowed, you get whatever the standard dividend is. The 50,000 that you have borrowed against the policy will receive a dividend rate that could be higher than 6% or could be lower than 6%. It 100% depends on the insurance company and how they treat direct recognition. I've seen some of the major mutual companies raise the dividend rates. I've seen some of them lower it on borrowed funds. But here's the thing, and this is why I say it doesn't make much of a difference. Usually, when I look at a company that reduces the dividend rate on borrowed funds, they're often operating with a very low fixed loan interest rate, meaning I'm paying less in loan interest if they're reducing my dividend on the borrowed funds. So the net impact is almost a wash or nothing at all. I included a video that goes over a direct comparison of that. Let me know if this one helps. Thanks so much.